All right, guys, welcome to Futures Friday. What a day. It's I guess what an overnight or economic data as usual sends us higher. And this was, as you guys could probably tell from the prep, a major area. And I will say this about the prep. Let me just share that screen right quick instead. This is a really large area. So while obviously it was, substantial destination intraday here, we could easily overshoot this area by, I mean, 40, 50 points. That overshoot, I'm not saying like we're going to go in a straight line there right now, but in general, as this unfolds over the coming sessions, plural, this could be a large destination that we get to, and we could trade above it, chop around. I'll then transition to similar to what we do usually, which is looking more so back over here at the profile chart, if I can find it. And you'll look for something similar to what we saw here, this area here, where you put it in an area where we're not really going anywhere. We're kind of balancing in an area, and then you look for direction that is a market transitioning from balance to imbalance from one of those areas. So I think it's a pretty good chance we see something like that. I'm not in the business of making those predictions, even though it sounds like that's what I was just doing. Perhaps I should say I wouldn't be surprised if, like I said, big overshoot, we could really see some days ranging in this area. But if we do put a balance in from there, then it's kind of a destination achieved, and we could look lower if we start to do that. Otherwise, hey, this market's on steroids, right? I mean, it's QE type stuff, and evidently the market's telling us that the reaction to the downside to the pandemic and whatnot was overdone. Almost at this point, you could say unnecessarily entirely, which is hard to believe for a lot of people, right? Myself included. But do yourself a favor and figure out real quick right here, right now, or at least take my word for it, or figure it out the hard way if you want. Those type of perceptions and what you think is smart versus stupid and rational versus irrational is ridiculous and will only serve to hurt you as a trader. For you to think anything that the market's up or down and it shouldn't be is preposterous. That's not what we're doing here. What we're doing here is trying to work an edge, a technical edge. Anything else is going to cloud your judgment. So it doesn't matter if the market, everybody's saying the market doesn't have a conscience right now and things like that, right? Well, yeah, it doesn't. It's an auction process, and the only thing that matters are participants and their perceptions and their needs. That's all that matters. And so it's the markets are not this perfect, just pricing mechanism that you think they are. And now what I'm saying is not going against auction market theory. It's you can still be, the participants can still be quote unquote wrong, even though that's almost a worthless word to use in this regard. But they could be, everyone could be idiots, let's say, right? Everyone could have the wrong perception of where value is and things like that, but that doesn't matter. What matters is that perception and where value is tracking, and that's our jobs. That's what we're supposed to do. I've just seen a bit more on Twitter and all kinds of places, people just kind of like, this is crazy. Wow, doesn't make sense, blah, blah, blah. And even the subtle comments, even down to the people coming up with the theories as to why things should be this way or that way is on an extreme. But even just the comments and being just like, this is remarkable, this is unbelievable. I think you need to check yourself. You need to check that you're not, that you may not be purely objective and purely focused on price, time, and volume and market generated information, which is, as far as I know, that's all this community is about, right? Now, look, if you're a fundamental person and you come in and you have those views, and you're free to express them and whatnot, but that's never going to be something that is going to be a big part of what we do here. So anyways, I've just seen some people get into trouble lately with views, let's say, on their hot take on what should be or whatnot, and gotta be careful with that. All right, let's turn it over to you guys. I see the questions starting to come in. One is from anonymous attendee. Please don't make your name anonymous attendee. At least come up with something. When recency of composites is so important, how we trade, what do we do on days like today? Well, I mean, we use other things other than balance areas when you don't have a balance area. You've got to lean on other long-term narrative charts and whatnot. Paul, how do we manage something that's in price discovery mode, thinking in Q currently? We may have an opportunity with other instruments if we keep going. I mean, look, we have markets that oscillate, like I drew up there earlier, between balance and imbalance. And, some of the main tenets of what I teach are understanding that condition across time frames and teaching people how to go execute trades in, as you call it, a price discovery mode versus how to execute trades in a non-price discovery mode or a balanced or range-bound environment. So you've got the first part down in terms of, and maybe I'm missing the question. How do we manage something that's in price discovery mode? Maybe you mean trade management. It depends on, look, this is all a limitless environment, right? That's what makes trading so interesting is, okay. And Paul clarified he was talking about targets. So, you create a process for trade management. You do, right? And it's never going to be perfect, but you hit on a key thing, which is this is the environment. It's really in price discovery mode, imbalanced. And so we can study markets and look at what might be ideal in terms of trade management on an intraday basis or whatever time frame you're trading. And you apply those frameworks to manage a trade, So for me, a lot of times I'll hold it as long as my a core position, that is, I'll scale out, but then I'll hold a core position as long as the market tells me intraday that that price discovery is still valid, and I have a framework for seeing that where it is true and where it's not. And so I will lean on those tools and those frameworks for understanding that. And does it mean that all my trade management is perfect? Far from it. But it's something that does do a pretty darn good job. JT, when you should sit on the bench during a session outside of hitting daily loss, when do you know? I'm sorry. When do you know when you should essentially sit out during a session, take a break, walk away, don't trade at all, whatever the degree of that might be, beyond hitting a daily loss? It's a great question. There's a couple different places where that might occur. And one of the most important ones is pre-market. So, part of pre-market prep needs to include not only analysis of charts and news, if that's a part of your stuff or whatever, but your market stuff, but also self stuff. So before you even begin a session, are you too sick, right? Is your physical state too sleepy, whatever, right? You might need to take essentially one of two approaches Dr. Steenbarger recommends to us. One is you enter the day in a uber selective type state, right? You've categorized your physical state as degraded. It's not optimal. You begin the day knowing that the way you're going to operate is not normal trading for you. It's going to be, I probably won't put on a trade unless there is something that is just an absolute layup. It's so A plus according to my playbook and what I look for that I'm not going to pass on it. And that's all I'm going to do, if anything. On the other hand, you may be in real bad shape and you may need to simply call it and go catch up on some sleep or go to the doctor or whatever, right? So there's different degrees of that. And let's also mention it doesn't have to be purely physical. It could be emotional, psychological, whatever. A part of a good pre-market routine is a self check-in, and that can extend all the way to kind of that underconfidence or overconfidence check-in that I like for folks to do as well. Beyond that, some people incorporate forced breaks if certain triggers happen. And it's not just like we pull the triggers out of thin air. Typically, these are things where people have identified, you know what, when I have two losers in a row, I'm prone to behave badly, right? So when you have two losers in a row, you take a 15-minute break, you do a fresh self check-in, you get your mind right, you get yourself to the point where you can truly confirm that you're all on board with the fact that the next shot is more important than the last mistake. And once you're there, then you're ready to go again. I've done all kinds of things throughout my trading. I've done everything from a mandatory walk around the block to mandatory, breathing exercises or whatnot. I've done all kinds of stuff. So breaks can be very helpful with, circuit breakers type deal. Other than that, look, if you come in and you say, look, I'm not seeing much today, or I'm not seeing things well or whatever, you've always got that right, I think, that discretion to make that call. Jeremy, I can't always be at my desk for the pre-market to prep. Any advice on prepping midday or other times than pre-market? Jeremy, it's a great question. Ultimately, it truly doesn't matter. We just call it pre-market. Really, we should call it pre-trading session prep. So for you, if your trading session is from lunchtime to the close, well then heck, that's your go-to, prep as you begin to, like I said, not only check in with markets and do your analysis and figure out, perhaps what the environment is, what the conditions are, what the opportunities are, if any, all the way to hypos as I get my students to distill things down to, and the self check-in as well. You're just doing it at a different time. You're getting your edge and your mind ready to go do what you need to do, and it doesn't really matter what time of day or night that is. All right, if anyone else has any questions, put them in the Q&A box. We'll get to them. Oh, I found a question in the chat. We'll address it. Does it make sense to weigh other related markets or symbols, S&P, NASDAQ, Russell, Dow, against each other to develop narrative for the market you're trading, such as the ES? Not sure NADRO covers this. Brent, this is a great question. I'm glad you asked. Let me give a precursor here, and that would be, I don't have the answers to any and all ways in which one could go about trading profitably, right? I'm one guy with my experiences and my particular brain, and I do certain things and have come to understand things a certain way. So with that said, I find it mostly useless to, in the common ways that your typical, and trust me, I went through this as well. You think, aha, what a great idea. The Russell's been leading lately, and then it looks like the S&P follows. Well, when I see the Russell breakdown, I'll just short the S&P. Easy money. No, guys, that doesn't work. Unless you're some kind of tremendously sophisticated spreading algorithm or even HFT type stuff, that is not going to work on any sustainable basis for you. Now, could you come up with some creative things that I haven't thought of and I haven't tried and maybe something works? Sure. Okay. But just in the generic sense that you're probably asking this question from, I haven't found much value there. One thing that could be of value is if you see broad indices all making significant breaks or whatnot. That lets you know that there is what we might refer to as breadth, that the move is perhaps more sustainable than otherwise. Now, that would be something pretty easy to back test, I think, if you were a decent back tester. I've not done that. The counter argument to that being valuable would be, it's probably just as easy for the S&P, the NASDAQ, the Russell, and the Dow to all attempt to break down significant areas and all fail to do that together and break back up. So just because they all do it doesn't necessarily mean that there's kind of a guaranteed sustainability to the move. So again, I tend to fall back on not a whole lot of use there. There are times, especially the Russell and whatnot, I think, and well, even the NASDAQ, where there's a decent detachment between what the two are doing. And you may find a bit better opportunities in one than the other per your playbook. So yeah, that's my thoughts on it. What NADRO teaches is how to analyze a market, determine the risk reward, and speak the language of a market and what it's up to, what it's trying, where it's trying to go, where things would substantially change if it were to breach an area, where the risk reward landscape is through that, and then short-term tactics to then go execute intraday on a lower time frame, whatever that is for you. Read order flow and understand, all that good stuff. That's what NADRO does. So, could you apply that to 5 different highly correlated markets and find some way that there's some value add there? You might can, but be very, very careful and cautious with what I mentioned to start that conversation around those generic, like, oh, one's breaking, let me short the other, typically not good. I would suggest, and I know a lot of really, really good equity indices traders who would back me up on this. And within the past 4 months or so, looked more into this myself. I'm not an expert yet, but I'm doing more and more of it, which is the actual breadth, right? So your NYSE tick, your advanced decline, your volumes in various regards, those type of actual. Some people correct me. Is it breadth? There's another word that some people use sometimes, but you know what I'm saying. Internals, market internals, I think is the most correct. That can be very helpful to giving you a sense of how much energy is behind a move, and whether or not it looks like it might be sustainable, or you're more likely to see more of a failure and reversion of that attempt at price expansion. Those tools can be really good for that. And, I know guys at SMB that have algorithms around using that information and whatnot. So that stuff is good. I'd recommend you go down that path rather than let me watch all the markets and see if they follow each other in some regard. Nika, are just 2 instruments enough to be consistent in any market situation long term? Looks like 2 is my maximum for intraday. I mean, I think 1 could be enough, quite honestly. Might you have to sit? I think the less markets you trade, it's kind of one of 2 things. Either your your basket of tricks needs to have more items in it. You need to have a bunch of different things that you can pull out of your basket and apply to one market, or maybe even 2. But if you're trading 3+ markets, well, your basket could have 1 main setup, 2 main setups, and you don't have to have as much. So it's kind of a personal preference thing, but can it be done? Absolutely. There's people who've made wonderful careers out of trading 1 single market. So it is enough to be consistent. So yeah, I mean, I'm with you. Like when you try and do too much intraday with too many markets, you get worse, right? You start to lose detail. You start to miss things, omit pieces of information that were important. And so I understand how you're saying, look, 2 is my maximum for the day. I hear you. But there's other ways to go about that as well. So one way, rather than trying to keep up with all these markets on a tick by tick basis very closely with intraday trading, as we typically do, you could start more with a pre-market prep across multiple markets and then narrow down to 1 or 2 that you're going to focus on, which is your maximum for the day. So a lot of different ways to go about doing the single market versus mini market questions. Your view on the importance of time of day for a trader from different time zones. I mean, there's obvious time of day factors in markets, but in reality, time keeps marching on and opportunities keep presenting themselves. I mean, in fact, I've noticed lately a lot of markets are providing ideal entries right into or just after the pit session close, right? And it's kind of it goes both ways there. It's hitting a target area, destination area, which is so good that it might as well be an entry in and of itself, right? So, who initiates positions into the close, right? Other than like long-term portfolio managers and stuff because of the liquidity during that time. But there's obvious differences in volatility per each time slice of the day, and you could have expectations around that. So you could do a study on, study the 30-minute bar range over time for each period of the day and look at how that's evolving and whatnot. So you can have a volatility sense of time of day. But I always like to tell people, if my A+ setup occurs at 3 a.m. or 2 minutes after the pit session open or during lunch, I don't care when it occurs. That's my trade, and I'll take my trade. I don't care what time it is. But with that said, there are obvious differences between K period in crude oil and one of the middle of the day type periods, right? On average, it's more volatile. So, do I ever trade a headline move? Yes, is the answer. But will that be just totally with no regard for my NADRO methodology or whatnot? No, it won't. Does a headline present additional opportunity in terms of a few more scalps here and there with the momentum and things like that? Yes. So essentially increased volume and volatility that come with kind of a real headline type move. You can trade them. And I'm talking about not putting the bet on before a headline is scheduled to come out. That's not what we're talking about here, okay? Just so we're clear. Headline hits, whether expected or not, and then the market is moving and showing opportunity. And I'm talking about trading it within the minutes to hour, following that. So pretty much the biggest difference between standard trading, if any difference at all, is that I'll just be a little more aggressive, a little more opportunistic, because things are flowing and moving so quickly. There's more opportunities per unit of time. Merritt, why do you use TPO only on the old pit session of crude? Likewise with ES. There's been such big overnight moves. Don't these matter in our profiles? It's a great question, Nathaniel. It's a great question. Not to be stubborn, but in one sense, what I do works. Okay, so I'm not saying that I'm just going to turn a blind eye to evolving or whatnot, because that has to be done as a trader, or you die. But just because there's some big moves overnight and whatnot, and look, with today, what was the number? So employment was supposed to be minus 500K and it was plus 289K. Oh, that's Canada. Sorry. NFP. There we go. Same kind of deal. It's supposed to be a huge down number and it was a positive number. So, I mean, the rally began from not really overnight. It was, the real rally started, at that 8:30 release. I know we were up a little bit overnight, but that's normal, right? Should we adjust our profiles to the first Friday of every month for non-farm payrolls to give us that data? No, it's okay to have some gaps and whatnot from those things. On as a whole, there's way less activity overnight to this day. I know it's 24-hour markets now, or 23-hour markets or whatever. It's in crude and the S&P, especially the S&P. The real business gets done during the pit session hours. It does. The big players depend on those opens and closes for those massive liquidity to get their stuff done, and even the liquidity that's there during the pit session. So it still matters. It's still relevant. It's not old school. It's still a thing. Just look at the volumes. Just put up a 24-hour chart and look at where most of the volume is. Other than your on-farm payrolls or, Brexit or whatever, that's generally the way it is. So for me, the migration of value and the features of the profile, that's what's most important, and it works well. All right, one more question here from Zhao. What would be your view on how to deal with FOMO? I mean, let's say you missed this rally that occurred today. Would you step away from the screen for a while? Would you have any internal psychological tools to help you? I'm trying to decide there's so many directions to go with this question. So what I teach students, and this is in our Futures Foundation program, you can check it out, to seriously begin to work on their mental framework. Give me 1 second. I'm sorry. All right, sorry about that. So dealing with FOMO, you need to work and be really diligent about building out what we call kind of your mental framework, learning how to think differently about your trading, about what it means to trade consistently profitably with a positive mathematical edge. You know, people who say you're, yeah, well, forget that. Um, there's math behind it, and you're making actions in order to have that realized or actualized, right? And so, and also understanding, very, very importantly, the nature of markets themselves, not just the job you're doing and as a trader and an edge and things like that. But so you kind of have to rewire various belief systems that we don't come pre-programmed with as humans. In fact, we're naturally bad, as you mentioned, FOMO. That's kind of a natural human reaction, right? Someone who has FOMO is not a unique human. You're a natural human. And to be a really good CPT, consistently profitable trader, you have to do some rewiring. And that takes time and that takes effort. And most people just want to find the proper moving average setting that's going to make them profitable. And it doesn't exist. And so it's extremely important. So, it sounds like I'm not addressing your question directly to how do you deal with FOMO. Well, what I'm saying is you can figure out how to do work on your belief systems and mentality with trading, which is going to it's going to create such an effect on you and such change in you that FOMO isn't going to arise as often, or when it does, it's going to be more easily manageable. If I were to just tell you how to deal with FOMO, that would be what I call a band-aid solution. It's not addressing the underlying issue, which is the origination of the FOMO. That's very, very, very important. But sure, if we can talk a little bit about the here and now and where you're at and dealing with it. Sure, if you have enough, and one of the requirements to doing any of this is self-awareness. If you have enough self-awareness to realize that the FOMO is rearing its ugly head before you do a bunch of damage to yourself, well, then absolutely, if you can step away and take that break, then that's great. So there's all kinds of things you can do to learn your triggers and cues and what happens. All right, guys, I've got to step away. Thanks for being here. Happy weekend. Sorry, I got to hop off for a phone call. Cheers.